I'm Michelle McCory. Thank you for joining us. New concerns about the stability of the global financial system are rattling the markets. Credit Suisse, a major Swiss bank with $1.4 trillion in assets under management, is on the brink of collapse. The stock is tanking down around 25% after Credit Suisse acknowledged that it found material weakness in its financial reporting. And Saudi National Bank, its biggest investor, said that it will not provide any further cash injections to the already battered bank. Now, Credit Suisse has large US and global operations, and this is putting added pressure on the financial sector, which is already under strain after the recent failure of three major US banks: Silicon Valley Bank, Signature Bank, and Silvergate. And fueling the fear, uncertainty, and doubt, BlackRock's Larry Fink, who says the US banking system may face more seizures and shutdowns. So, how bad can this get? What does this mean for the Fed's next move? What does this mean for your investments and trading portfolio? And where are the opportunities in this crisis? Well, who better to ask than the one and only Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com and president of VerifiedInvestingEducation.com. Gareth, welcome back to Kitco.
Thank you, Michelle. Thanks for having me back.
All right, Gareth, we have a lot to discuss. We're going to get your thoughts on this banking crisis, your outlook on the latest inflation data, what it means for the Fed, where the S&P is headed, on Bitcoin, on gold and silver. It's going to be an action-packed 30 minutes, so let's do it. All right, let us start off with Credit Suisse here. The bank shares falling around 25% today. Just as a recap for our viewers, on Tuesday, Credit Suisse published its annual report for 2022, which said that it had identified, quote, material weaknesses in controls over financial reporting, and that it had not yet stemmed customer outflow. And then this is, of course, Switzerland's second biggest bank, and it had seen fourth quarter customer outflows rise to more than 110 billion Swiss francs. That's about 120 billion US dollars. Then we had the chairman of Credit Suisse's largest shareholder, Saudi National Bank, go on Bloomberg TV and say that the Saudi bank was not considering topping up its investment because that would trigger regulatory rules, because Saudi National Bank owns 9.9% of Credit Suisse, over 10%. That's a whole regulatory hurdle. So now we know that Credit Suisse has been the problem child of European banking for several years. It's had repeated scandals and financial losses for the bank. This isn't really new on that front, but this is getting really, really worse. And this is a bank that's been around 166 years. So it's not likely that the authorities are going to let this fail. I mean, analysts are expecting a bailout here by the Swiss National Bank and potentially regulators. What are Gareth Soloway's thoughts?
Yeah, so this is a mess, right? I mean, this is a basic financial crisis 2.0, if you will. And what we're seeing here is Credit Suisse, which already was in a tailspin. And if you look at the chart, right, the daily chart, you have JP Morgan Chase, you had Goldman basically trading near multi-year highs just over the last couple months before this recent collapse. But Credit Suisse was nowhere close to that. It was already in a downtrend. It was already at multi-year lows. So what that was telling us is that smart money knew this was the bank that was going to be in trouble. It was going to be one of the big ones to be in trouble first when we got a situation like this. And when you have interest rates rising this dramatically, right? So we're not just talking about, it's 4 point something on the Fed funds or 5%. We're talking about where it's come from. So it's the velocity of the move that has broken the system. And part of that is the fact that the Federal Reserve basically mismanaged things, right? They said everything was transitory when it came to inflation. They were wrong and had to play catch up. So again, even when we were out of a financial crisis due to COVID, they still said, we're going to still leave it as is, zero interest rates, essentially free money, because we don't want to rock the boat. Well, the end game is they had to play catch up here. And now you're seeing whether it was Signature Bank or SBNY or even Credit Suisse here, these are some major issues. And that's going to be something that the European Union has to deal with now.
Any particular thoughts on Credit Suisse and the stock? Short, buy?
Yeah, so this is the key, folks, and I'll say this is I've been nibbling on a few different financials, like a little bit of Goldman Sachs, a little bit of JP Morgan, and I've been buying some ETFs that are spread amongst many of the banks out there. And the reason I'm not touching Credit Suisse is much the reason why it was a bad idea to touch SBNY or Silicon Valley Bank is that you're basically putting your money in one asset that we know is already trouble, and we don't know how bad this is going to get. So my recommendation is go with the best of breeds if you're going to nibble small, or go with an ETF that spreads your risk out across the board. But Credit Suisse, this is one of those things. It's like a Lehman moment potentially, where we could wake up one morning and it's shut down, much like we saw with Lehman Brothers.
All right. And, as we've said, this is obviously adding to the panic. Credit Suisse dragging down the European banking sector, U.S. big bank shares declining in sympathy, if you will. Even the big players, Citigroup, Wells Fargo, shedding around 5% respectively. Goldman Sachs, Bank of America, all down. As we've covered, we've had three big bank failures: Silvergate, SVB, and Signature. And we've had Larry Fink, the CEO of BlackRock, which is the world's largest asset manager, raising the prospect of even more bank seizures and shutdowns. He's saying we don't know yet whether the consequences of easy money and regulatory changes will cascade throughout the U.S. regional banking sector, with more seizures and shutdowns coming. Big picture, do you think that this is where we're headed?
I do. I don't know how many more seizures will occur, but I do agree with him that inflation is going to remain elevated above that 2% mandate that the Fed has said. I've said this for the last year or so. To get inflation down from 9 or 10% to 5 or 4%, that's the easy one. That's like, you lose 10 pounds at the gym. To get that final six-pack, it's a lot of work. And that's where we are at this point, where, again, it's going to be very tough because, remember, wages skyrocketed. You had companies that were paying $10 an hour that now have to offer $20 or $25 an hour. They weren't able to pass that cost over to consumers day one. So what they're going to do to keep their margins in line and get those margins back is inch that into the consumer's pocketbook, essentially, over multiple years. And that's going to take some time. So you're going to be looking at elevated inflation rates. And again, we have to be ready for something probably around 3 to 3.5% for multiple years to come, which is the scariest thing of all, because now we're in a crisis where normally the Fed could be like, oh, well, let's lower rates to save the day. That can't happen now. They're basically at a point where, they could pause, but we just saw PCE numbers recently that were sky high. They can't be cutting rates yet.
All right, before I unpack in greater detail what you expect from the Fed, I want to just get your thoughts on your trading approach regarding the banking sector, because you said you are nibbling on some of the bigger players. Tell us more about that.
Yeah, so on a chart like Goldman Sachs, I mean, we've now come down just in the last few days from $350 to near $300 a share. I mean, these are banks that may have some exposure, but they're a lot more nimble and bigger than a lot of the regionals out there that are having a lot of trouble. And you have to assume that their management is better too. And I think that's one of the big things here is, yes, it's partially the Fed's fault that you saw these collapses because they raised rates way too fast and these banks weren't prepared for that. But at the same point, their management was way behind the curve. To be being paid what these management companies and CEOs are being paid at these banks, and to fumble the ball like this is not acceptable, frankly. And I think they have to be held accountable, not just the Federal Reserve, but Goldman Sachs, JP Morgan. These are best of breed banks. So at least in the near term, I think you play them for a bounce. I'm not saying that, again, this is a buy and hold for the next 5 years, but you're looking at a short-term technical bounce that's probably getting close.
How short-term?
Oh, boy. So, I mean, for me, it's more of a price point. So if we look at the chart here on Goldman Sachs, I would be looking at a bounce back to about $330 to $340, which nets you about 10%. So you look for a 10% snapback over the next couple of weeks to month, and then you kind of step aside and say, okay, let me reevaluate. Because remember, this is the kicker, is that we are going to go into a recession. There's no way around it at this point. I just think it happens in the second half. And then once we go into a recession, then these banks are going to be put under new additional pressure from economic issues.
Right. And as you said, a lot of this is happening because these banks have struggled to cope with the sharp increases in interest rates over the past year, which were clearly coming. The Fed was clearly telegraphing those moves, and it was a lot of interest rate hike failure of managing that risk with their investment portfolio. And look, as you mentioned, the Fed has been very aggressive. It's engaged in the most aggressive series of rate hikes since 1983. And Fed Chair Jerome Powell seemed very adamant that he's not going to repeat the mistakes of Volcker in the 80s, who cut rates too quickly, saw inflation return. This is, of course, the same Jerome Powell who said that inflation was transitory, so let's keep that in mind. We had him speak last week or so saying he needs to go faster and harder and for longer. But now that we've got the banking industry at the edge of a precipice, do you think that Powell can continue with this approach? Because the markets seem to be pricing in a potential pause in hiking in the upcoming March 22nd meeting. There are thoughts that maybe to save face, he'll throw in 25 basis points, but certainly 50 basis points is out of the question. What are you expecting for the next meeting?
Yeah, so I'm expecting 0 to 25. And again, I think in the next few days, we're going to know whether it's 0 or 25. If things get worse, it's 0. If things calm down, then I think he might do 25. But you had mentioned, too, that the Federal Reserve had telegraphed their rate hikes, right? And it makes it think like, oh, well, how are these banks so dumb to not recognize when he basically said, hey, guys, we're raising X, Y, and Z, so be ready for it. The problem is that in reality, the Fed has almost no trust value, meaning that, where's the credence when, in 2018, they basically reverse ship immediately. They've been basically the drug dealer to the market, just feeding it liquidity constantly over and over again at the littlest issue out there. And so you can't blame people for saying, oh, well, the Fed will just save us if something goes wrong, and starting to believe in that when the Fed has made us believe. And now all of a sudden the Fed's deciding to stand up and cut off the supply. That's my issue there is with the Fed, is that they're not fully trustworthy in what they say over time.
And Gareth, that's a point that you've been making on this show for a very long time, as well as other guests, that markets have just become so used to the Fed coming to the rescue, the Fed supplying the drugs, which it has since 2008, and that with these recent rate hikes, there's been a supply halt and withdrawal symptoms, a nasty hangover. Not to mix metaphors here, but we've also been saying that the Fed is going to raise rates until they break something. So is this the point of breaking something? You're expecting a pause at the March 22nd meeting. And then what? Hold steady? A pivot? What do you expect?
Yes. And so I'm expecting basically 0 to 25 basis points. And again, I would say in between now and that meeting, we're going to know based on if things get worse, it's 0. There's no rate hike. If things calm down, and let's say Europe kind of calms down, Credit Suisse calms down, then I think you're looking at a 25 basis point hike next week. So again, I think that's the angle to take it. And then after that, I honestly don't expect any additional hikes. I think we saw the PPI numbers coming in negative today. That's important to recognize. And again, that's showing us that at least on the producer side, prices are actually starting to drop. And then I think just the action of the instability that this is creating in the financial system, the Fed is going to have to back off and wait and see. They're going to have to take a wait and see approach, which is what they should do. And honestly, they probably should have done a little while ago.
Yeah, but inflation on the CPI front, yes, it's cooling, but it's still 6%. I mean, and that is the reported inflation. And of course, There's a whole lot of controversy as to exactly how reflective that is of the real inflation on the ground. So given this, you're expecting a pause, no more rate hikes for the rest of the year. You're expecting the new normal of inflation at what?
Yeah, so I do think inflation comes back down by end of year. We'll probably be looking at a forward inflation rate of let's say 3.5%, kind of what Larry Fink was saying in his comments this morning. But I think, again, that's a problem because the Fed is not going to be able to cut rates aggressively unless stuff gets so bad. And, we're looking at the regional banks and what's going on in Europe and saying this is really bad. But this isn't even close to as bad as it has to get before the Fed is willing to actually cut rates if inflation is above 2%. And that, I think, is scary to me because, what does it look like if it gets to that point where the Fed actually has to lower interest rates?
Yeah, what does that look like, Gareth?
I would say S&P sub 3,000 at minimum. In fact, per the S&P chart here, that's what I'm expecting. So I'm expecting, again, a little bit of a break lower here. We're obviously seeing downside down to basically the pre-COVID highs, which is right around 3,400. That's first stop. We're about 450 points away from that at this point. And then ultimately, I think by year end, we're at 3,000 or sub 3,000 on the S&P 500. So it's going to get worse. And this is the issue is that, remember, the markets have been conditioned, investors have been conditioned to say, anytime we hit a hardship, anytime we get into a recession, the Fed will bail us out. The problem is we're going to get into a recession in the second half, and the Fed's hands are going to be handcuffed. They're not going to be able to bail us out like they have done in the past.
And you're saying that yet if the Fed does actually start to cut, that's going to be worse for the markets?
So if they actually get to the point of cutting, we are probably in such a catastrophic event in the market system, in the economy, that's why they're doing it. So I'm thinking that you're going to have to see like north of 8% unemployment, maybe 10% before they cut in the next 12 months. And again, I don't know if that unemployment number will happen, but we have to realize that if they start printing money again with inflation at 3.5%, where's the next stop? Is it 15%? Is it 20% before? And so they are realizing this as well. We know that you mentioned this earlier, that Volcker had an issue where he kind of lowered rates too quickly. Jerome Powell says he doesn't want to repeat that. So he's very aware of that issue that could arise. And so he's going to try to hold back as long as possible from cutting, as long as inflation's above that 3% area.
Right. You know, the markets had been trading on the idea for the longest time of bad news is good news, meaning what it means for the Fed. But there does come a point where bad news is just bad news, and that is seen across the board in terms of equities. Your outlook for gold, though, is still very positive. You still hold the view that gold will outperform other assets this year.
Yes, and I continue to be in that camp, and it's having a beautiful move up today on the day. Obviously, any sort of fear, instability. Number one, people run into the U.S. dollar right now. Number two, gold is that recipient. And weirdly enough, I know we'll get to it, but recently Bitcoin has been the recipient as well, which is really, really fascinating to see. But for me, gold is putting in a bull flag that started in 2020, and at some point, this is going to bust out to the upside and have a big move up. If you look at the 1970s chart, this is the same pattern price. In fact, I'll show this real quick. So we had this start here in 2018 on the chart where we went up for 2 years to 3 years. We've now consolidated for 2 to 3 years. If we go back to the 1970s, we can see that same sort of pattern recognition during that inflationary period. Gold went up for 2 years to 3 years, consolidated, and then the next rip took it from about $110 to almost $900 an ounce. Now, again, I don't think it's going to go to do a 9x or anything like that. I think a 4x, 3x is probably more in line because people have an option of Bitcoin and crypto now. But nonetheless, the history is repeating here as the inflation numbers are repeating.
Couple of questions on gold. A 4x over what time period?
I think, again, if you go back to the 70s, that occurred over about a 5-year span, 5 to 6 year span. So that's a pretty darn good return. I mean, we haven't seen returns on that in gold since the 1970s. So that would be sweet.
Are you ready to call a bottom for gold for 2023? Yes. What level is that at?
I do think those October 2022 lows, which were around $1,615, I do look at that as being the low. You have a beautiful channel. We just have to break through that channel, which is around the $1,955 level. If that happens, you'll test 2070, which is that double top high. And then once that's gone, then you're going to see the money rush in. And if you think about it, right, if a recession does occur, which is the likely scenario, are investors going to still want to be in stocks with the fact that the Fed can't stimulate and get us out of a recession? What if we're in a 3-4 year recession? Where's money going? Well, the answer is there's two places. There's metals like gold, maybe silver, and then there's cryptocurrency like Bitcoin.
All right, we're going to break down Bitcoin a lot to discuss there, including some of your correct calls there. But let's just stick with the precious metals for a while, because you did say that you thought gold and silver would outperform other assets this year. The gold-silver ratio currently around 83. Do you think that silver is underpriced? Does it have more upside percentage-wise than gold at this point?
It is slightly underpriced, but for good reason. So we have to remember it's an industrial metal. So if the thinking is like mine, that again, the economic situation is going to slow down, well, then the industrial side of demand is going to slow as well. And I think that's why you're seeing that underperformance in the near term here. But ultimately, it's still a metal. And if inflation stays high for a longer period of time, you are going to see silver rush up. And eventually it will outperform gold, like historically it has. It's just this period of uncertainty with the economy and likely recession is keeping it under wraps. I still like it as a long, though. I think for me, the pure play for being a protection player of my assets is gold. But if you want that beta, that alpha, I should say, that return, then silver is where you got to look, probably late second half of 2023.
So the consensus thinking, Gareth, has been that gold is going to hit a new all-time high in 2023. Does the same apply to silver, given, as you say, you've got the industrial use factor, which gets dragged down with a global recession? What's your 2023 silver outlook?
Yeah, so I think silver will likely test its highs. I don't see it breaking the $30 level this year. And the main reason for that is that industrial side. I think that keeps it from really breaking out. Now, granted, from $21.80 right now where silver is to $30 is still a tremendous return just to get back to those highs. But again, my guess is the breakout probably occurs in 2024.
In 2024. And what would trigger that?
I think that's just kind of more of the same in terms of the economics picture, maybe getting a little clarity, maybe a return to kind of a little bit more of industrial demand as we get later in 2024, or at least the expectation of that. And then it becomes the asset to be in with inflation still elevated.
Okay. Speaking of recession and global recessionary concerns, want to touch on oil very quickly. Oil falling more than 6%, lowest in more than a year. As banks are starting to fear this idea of a global recession. What's your outlook on WTI?
Yeah, so for a long time, I've been saying, hey, guys, oil is going to go down to about the $65 level, maybe as low as 63. Today, we flushed down there. And again, this was a massive dump out. If we look at the intraday, the selling was just nonstop for a large chunk of the day. We have seen a bounce back, which is awesome. But nonetheless, this is actually a level where I started to inch in a little bit on the long side of oil. And I'll show you on this chart. If I zoom out, this is a major, major technical area. We're going back to levels that were pivot points in 2019 all the way through pivot points in 2021, and we've now retraced to this level. So you should see some support here. I think, again, a little bit of an overreaction here in the near term, and I expect oil to bounce. I am long on the oil front on WTI here.
Long also on oil-related shares and equities.
Yes. In fact, I nibbled on a little Devon Energy today, DVN. That's just gotten absolutely punished. But again, if we look at the chart, for me, it's all technicals, which means it's all probabilities. The probability here, look at that level right there. Major support here, and that's exactly what we're hitting. So again, the idea is we should see some sort of retrace back into the $50 range or around $50 on Devon Energy.
I mean, energy was the best performing sector in the S&P 500 in terms of equities in 2022. What is your outlook for the energy sector for 2023?
Yeah, and just in that note, folks, and I speak out there hoping that people listen here, that if you turned on CNBC or you turned on these stations, everyone was saying, you got to be in oil, you got to be in oil services and Exxon and Chevron. And what was that? That was the top on those stocks. So I always caution people is like, do your own research. Don't just go by what the talking heads are saying. And it's even for myself. When I say something, don't just take it as gospel. You got to do your research, do your analysis. Now, for me, I think oil has a technical bounce here, but by second half of 2023, I think we have another leg lower as the economy spins into recession.
All right. Bitcoin. This is the topic we want to break down into great detail. You've had a number of correct calls on Bitcoin, including it testing and breaking through 25,000. Bitcoin has been doing well in this environment, surprisingly well, perhaps because conceptually it is seen as an investment away from traditional finance, away from centralized finance, which is why it was conceived by Satoshi in the first place after the financial crisis of 2008. Bitcoin kind of weathering the storm there. It's up as of this time about 46% year to date, beating stocks and gold, even though we do have a slightly stronger dollar. Break down your Bitcoin outlook for us.
So something you mentioned, which you can't help but smile at it, is that the fiat system, the banking system, is actually helping make the case for why Bitcoin is a necessity here. And I think that that's something that we have to all kind of take note of, and then also say this is a major step. I think we're going to look back at this period and say this is one of the key moments why Bitcoin is now such a major asset in 5 or 10 years from now. So ultimately, do I think that the selling in Bitcoin is over? No, honestly, I don't. I think that in the short term, the fear in the banks caused a lot of money from banks to go into Bitcoin as a safety play. I also think that we saw USDC decoupling over last weekend. People said, hey, I don't even want to be in stable coins right now, so I'm going to go into Bitcoin as well. So I think that was kind of the reason for this latest move. I think once the financial system comes a little calmer, then you might see Bitcoin head down. And I still worry that if I'm correct that the S&P is going to drop another 25% or so from here, then I do think it drags, just by fear, it drags cryptocurrencies lower overall. Now, long term, I'm a huge bull on Bitcoin, and I think I get classified as a bear because I've talked about a fall since 69,000. But long term, I still love it. I think it's the future of the digital gold world. And I think that there's a real need, and we see it today. There's a real need for Bitcoin.
Look, you did say it was going to break and not hold at 25K. It's at around 24,200 at this time. You have mentioned that your short-term target is for Bitcoin to pull away all the way down to 13,000 and even to 9,000. Is that still your sort of short-term call on Bitcoin? And exactly in what timeline?
Yeah, so I think you have to be looking at in the course of this year. By the end of the year, I likely think we'll at least hit 12 to 13,000. And the basics of this are that, number one, we have to still wait for regulation. So especially with the uncertainty, I mean, yes, the banking situation has pushed money in here, as has the USDC issues. But I think ultimately we have to remember that you're at a point where regulation is still keeping big money out, and that people are still subject to absolute fear. So when we get in a scenario where we start to see more and more panic selling in the markets, in the economy is starting to dip into recession, my guess is it gets sold across the board. So in assets, maybe gold survives in that period and doesn't dump, but even during COVID, if we remember the COVID collapse, even gold dumped. And that's where I kind of think that we're going to see the big dump on Bitcoin, one final flush down. I'm going to be waiting and nibbling kind of once we get in that sub 15,000 level, all the way down to 9,000 if it gets there.
So you're saying that it's not going to be seen as a safe haven asset, and that fear is going to get the money out of Bitcoin, even though it is supposed to be seen as a safe haven asset by Bitcoin maxis?
Yes, and that's what I believe. So in the near term, right, so based on what's going on in the banking system right now, it actually has had a little period of this is a safety play to put money into Bitcoin. But if you look historically at Bitcoin, it's gone down when the stock market's gone down. And I think that isn't fully decoupled yet. I think we're seeing these flashes of what Bitcoin can be, this amazing asset that is a protection asset against other issues in the global sphere. But it's not quite there yet. It's still an immature, right? It's a 14-year-old. So it's a teenager. It's wild. It's crazy. We have to be ready for that. And I do think when the S&P, if the S&P dumps as much as I think, Bitcoin will get caught up in that selling. Remember, a lot of these assets, there's kind of cross breeding, meaning that as we see stocks drop, they're going to be margin calls, and they may have to be met through selling some of crypto. So it kind of all gets caught up in that scenario.
So, well, a couple of points there. I mean, one is, of course, the best way to diversify and to have an uncorrelated asset. But before we get into what that could be, all right, so Bitcoin is a teenager. And as we know, teenagers never behave exactly how you would like them to behave, can drive you insane. So you're thinking, what, 13,000 Bitcoin by 2023? What is your 2023 outlook if, as you say, all of these recession concerns come to fruition, the S&P 500 tanks as much as you expect that it will? Yes. I know it's out there, and I know a lot of things can happen, but right now, what are you looking for Bitcoin to be at?
Yeah, so Bitcoin ran into a ton of resistance. We can see again on the chart here, the high from August of 2022. That's exactly what we've hit over the last couple days here, as well as about a month and a half ago. And my guess is what we're going to do is we're going to come down and test this level of two major trend lines that coexist here at around 18,200. That's going to be a technical bounce level, no doubt about it. But if we break that, then we head to that 15,600 level. You break 15,600, and then the next stop is that 12 to 13,000 level. So again, my projections are showing that eventually that will happen, likely by year end, and we should revisit that 12 to 13,000. I think the 10,000 break to 9,000 would be a case of the all-out bloodbath that would actually put in the bottom. As you think about how many people probably have stops right around 10,000, and that break point would create max fear, which actually is how bottoms are made.
What does it do to the narrative that Bitcoin is supposed to be a hedge against inflation when we'll be seeing, as you anticipate, that inflation cannot be controlled by the Fed, that inflation will continue to rise? What does it do for that argument then?
Yeah. So right now, right? I mean, if we look at inflation and what it's been over the last 12 to 18 months, and then what Bitcoin's done, we see it's definitely not a hedge, right? It's definitely not. Bitcoin has come down from 69,000 all the way bottoming out to 15,600. So that's not the case at this point. I do believe it becomes that asset in the future once we get regulation in there, we get transparency and all these other things. But yeah, right now that's not the case, even though it's showing glimpses of what it wants to become. Like, think about this, right? You have a 14-year-old and you go out on the basketball court, or you go out and they show you a couple glimpses of being a superstar, but they're not a superstar yet. So Bitcoin is doing just that. It's got to mature. It will mature, and it will be that superstar down the line.
When can we see Bitcoin become that superstar?
Putting me on the hot seat. Oh, wow.
So I would say, Gareth.
I would say you got to give it another 3 years or so. We got to get through this area. We got to get transparency with regulation. So let's get the regulation out there. I'm rooting for them to get regulation out there. The sooner the better, because we have clarity as investors. Investors love clarity. We want to know that our money's safe. We want to know what's going on with our money when we're investing in things. That's the best case. I think, again, 3+ years out, it becomes that mature entity and can actually thrive.
All right, Gareth, well, seeing as you've touched on regulation, I do want to kind of delve into that a little bit, because in the midst of this crisis, there are rumors, speculation, that one of the banks that was closed down, Signature Bank, was in fact a target of what is known as Operation Choke Point 2.0. And that is an attempt to cut off the crypto sector from the banking industry. Now, Operation Choke Point, the original, is a government program to counter money laundering. And there are two angles here. Firstly, the Justice Department was investigating Signature prior to its failure on Sunday, and it does face allegations of money laundering. But there's also speculation that Signature was arbitrarily shut down despite no insolvency, because regulators wanted to kill off the last major pro-crypto bank. Former US Representative Barney Frank said that he believes that the officials behind the action were trying to make an example of Signature Bank in a takeover that he said was the wrong move, and that despite a wave of withdrawals, the bank situation was in fact under control before regulators swooped in. And according to Barney Frank, this was just a way to tell people, we don't want you dealing with crypto. Now, Frank, if the name sounds familiar, that is, of course, because he co-authored the Dodd-Frank Act that boosted government oversight of banks following the 2008 financial crisis. And Barney Frank was a director at Signature Bank. But we do have the situation now where we're seeing a regulatory environment for crypto that has become more and more intense. Now, you're waiting for regulatory clarity, but we're not getting that. In fact, so far, we're getting harsher action, so much so that we've even got Congressman Emmers asking the FDIC to answer to questions whether the agency has instructed banks not to provide services to the crypto sector. So we're not getting regulatory clarity, we're getting tougher action. Perhaps, what does this mean then for the extension of crypto winter?
Yeah, for me, the crypto winter could be longer than the past, right? And the concept there is simply that the Fed's not printing money. So again, we look at every past winter, the Fed has always been doing quantitative easing or interest rates were going down. We're not seeing that. So right there, you have to say, okay, I have to be open to the possibility this winter may last longer. And then again, the key is, you're right, the regulatory issues. You talk about Signature Bank, and like basically what that would say to me is, don't mess around, because if you need help from the government and they're investigating you already, they're liable to make you a scapegoat, or at least, make an example of you and shut you down. And I think that's the key. So I mean, I think that ultimately the regulatory stuff, there's so much speculation, there's so much craziness. I just want to know the freaking rules, right? Mm-hmm. Give me the rules and I know how to play the game. And right now we don't know those rules. And so it makes it very hard to allocate large percentages of any portfolio to crypto when you don't know the rules.
Is regulation still an existential threat to Bitcoin? Can it still be regulated out of existence when you throw in CBDCs, central bank digital currency, so forth and so on?
I don't think Bitcoin can be. I think Bitcoin is here to stay. In fact, I think the recent issues with the banks has even put it more kind of in the DNA of the financial system now, where people are even more into the trusting of what crypto brings to the table. Now, when you look at some of the altcoins, a lot of the altcoins have to go away. They don't have a lot of use case. I think there's a lot of shady stuff that we still don't know about them, but that's where the regulation to me needs to come in. Bitcoin, honestly, I don't think the regulation is going to touch it too much, aside from reporting and taxes and this other stuff. But for the altcoins, that's another story. I'm not so in tune with investing long-term in altcoins, maybe Ethereum a little bit, because I think that has a business that's really fundamentally inbred in the crypto markets. But with Bitcoin, that's the pure play right there. The digital gold, that's the one that long-term I feel most confident in.
All right. A final thought, because in the midst of all of this chaos, we have huge geopolitical developments as well, which obviously play a role in safe haven assets like gold and in what Bitcoin is supposed to be a safe haven asset. We've got conflict in Ukraine and Russia. Obviously, that continues to escalate, but now we have a Russian fighter jet shooting down a US surveillance drone over the Black Sea. This is the first direct military confrontation between the US and Russia since the start of the war in Ukraine. And the Kremlin has been warning that the US needs to cease hostile activity near its border, and said that it's going to retrieve the wreckage of this American drone and take it from there. And of course, this is causing some backlash from the US in terms of rhetoric. How concerned should we be about this?
So to be honest, I'm not super concerned at this point if we saw a ratcheting up of the aggressive stuff, past this point. But I think right now this is kind of par for the course, which is you have a little tit for tat kind of thing going on, where Russia just says, hey, listen, you guys are supplying Ukraine with all this aid. We're going to do these little things to at least show you that we have some strength and we have some skills to kind of make you hurt a little bit. Again, it doesn't remedy the situation. But for me, I mean, to be honest, look at the oil markets. Is that not the biggest kind of pressure that you can put on Russia right now? And when you see this drop, I mean, again, do I think that the drop in oil was directly related to this? No, but do I think that also you could also view it that this is actually putting more pressure than anything else that the U.S. could do to Russia? Yeah, so you have to kind of connect the dots. Maybe there's something there. Okay.
One final question for real. You did say, we did discuss that, everything is correlated in a way. You said if, everything goes down, well, perhaps with the exception of gold, you said Bitcoin goes down if the markets go down, oil goes down, that all of these assets get swept together in this fear trade. What is the way to diversify then? What is the best uncorrelated sort of long-termish move?
So for me, it would try to be diversified in some of the metals, specifically gold. I think gold miners will really start to benefit. If we remember when inflation was at 9%, gold miners did horribly because the price of gold wasn't keeping up with their costs going up. Now we see gold starting to go up, and that's where the miners can really thrive. So if we see inflation, let's say, coming down to 3%, but gold's up 20% a year, those miners are going to be just absolutely in a perfect scenario. So gold miners, and I think you start looking at some of the defensive plays. Like, what do people still need in a recession? They need drugs. So something like Amgen would be an interesting play, trading at the lower end of the chart recently, and maybe something like an IBM that pays a good dividend. I think people have to start looking for the safety plays versus the tech trade. The tech trade, honestly, has been so hot the last few days because everyone's rushing out of banks. I think that's a false flag, if you will. I think you got to be a little careful with the tech stocks because when a recession does hit, they're going to be the ones hit the worst. All right.
Gareth, for those that can't get enough of you, the good news is they can get you live with your gameplay every Wednesday morning. Give us the details there.
Absolutely. So right now I'm doing it once a week, every Wednesday, 9 a.m. Eastern time. It's called the Game Plan. And basically I come on, I give you all the analysis you need for trading for that day, for swing trading, for investing, what the macro view is, and basically all the trade setups I'm looking at. So again, that's 9 a.m. You can follow it on Kitco. Kitco's broadcasting it live. I know that every Wednesday morning at 9 a.m. And then also my YouTube channel. You can find it there as well.
All right. Well, thank you for giving us a slightly longer term outlook in our chat today. Appreciate it as always. And we will have you back on very, very soon. Gareth Soloway, thank you so much.
Thank you, Michelle. What a pleasure. Thank you.
All right. Thank you. And thank you for watching Kitco News. I'm Michelle Macquarie. If you're watching us on YouTube, don't forget to subscribe. We'll see you soon.